Warren Buffett is renowned for his straightforward wisdom, and one of his most famous quotes has become a guiding principle for investors around the world. The quote's appeal lies in its simplicity and logical approach to decision-making in the financial markets. By distilling complex investment strategies into clear, actionable advice, Buffett makes the world of investing accessible to both beginners and experienced professionals. His words resonate because they cut through the noise, offering a practical framework that anyone can understand. This timeless guidance continues to influence countless individuals, shaping how they think about risk, opportunity, and long-term success. While the quote may appear compelling at first glance, it's important to pause and consider its authenticity. Sometimes, statements that seem insightful can be misleading or even deliberately crafted to influence investor behavior. By accepting such quotes without scrutiny, investors risk falling into hidden traps that could impact their decisions. It's essential to question the source and context of any advice before acting on it. This approach helps safeguard against potential manipulation and ensures that investment choices are based on reliable information. At the heart of Warren Buffett's quote lies a subtle challenge for investors: the word eventually. This term suggests that, given enough time, the market will correct itself and reward sound decisions. However, relying on eventually can become an intellectual trap. Investors may underestimate how long it can take for their strategies to pay off, leading to impatience or poor judgment. The ambiguity of eventually can foster overconfidence, causing individuals to ignore short-term risks or market volatility. Understanding this nuance is crucial for making informed investment choices and maintaining realistic expectations. Before we delve into the underlying trap, it's essential to recognize that Warren Buffett's famous soundbite leaves out a crucial detail. While his advice often appears straightforward, the omission of a key component can lead to misunderstandings about its true meaning and application. Without grasping what's missing, listeners may interpret the message too simplistically, potentially making decisions that don't align with Buffett's actual philosophy. By identifying and understanding this critical element, we can avoid common pitfalls and gain a more accurate perspective on his guidance. Only then can we fully appreciate the nuance behind the soundbite and proceed to unravel the trap it sets. The quote is often cited in investment circles as a blanket endorsement for any financial decision, regardless of its merit. Many people interpret it in a simplistic way, believing that it validates all forms of investing, from stocks to speculative ventures. This widespread usage tends to overlook the original context and intent behind the statement. By applying the quote indiscriminately, individuals may justify risky or poorly researched investments. Such interpretations can lead to misconceptions about sound financial strategies. It's important to recognize that not every investment aligns with the principles the quote was meant to convey. Understanding the nuances behind the quote can help investors make more informed choices. Consider your own experiences with companies that are widely regarded as industry leaders or household names. Have you ever noticed that, despite their strong reputations and impressive products, their stock prices remained stagnant or even declined for extended periods? Reflecting on these examples can reveal how market performance does not always align with a company's public image or perceived greatness. Sometimes, even the most admired organizations face challenges that impact their share value over time. What factors do you think contribute to this disconnect between reputation and stock performance? Taking a moment to recall such instances may offer valuable insights into the complexities of investing and the unpredictable nature of financial markets. Many investors assume that owning shares in a well-known successful company guarantees strong returns in the stock market. This belief often drives people to seek out popular brands or industry leaders, expecting their stock prices to rise steadily over time. However, the reality is more complex. A company's business success does not always translate directly into exceptional stock performance. Factors such as valuation, market sentiment, and broader economic conditions can influence share prices independently of a company's fundamentals. This myth can lead investors to overlook important considerations, such as whether a stock is already overpriced or if future growth is sustainable. Understanding the distinction between a great company and a great investment is crucial for making informed decisions in the market. Investors often seek reassurance during periods of market uncertainty, and a well-chosen quote can provide much-needed psychological comfort. When stocks underperform, emotions like doubt and anxiety tend to surface, making it easy to lose sight of long-term goals. The right words can remind investors of the cyclical nature of markets and the importance of patience. This psychological boost helps them resist impulsive decisions and maintain a disciplined approach. By offering perspective and encouraging resilience, such quotes can serve as a stabilizing force, helping investors navigate challenging times with greater confidence. Throughout history, even the most admired companies have sometimes disappointed investors when their stocks became excessively overvalued. A notable example is the Nifty 50 bubble of the early 1970s, which featured a group of blue-chip stocks considered almost invincible. Despite their strong business fundamentals, many of these companies were trading at extremely high price-to-earnings ratios. When market sentiment shifted, their stock prices fell sharply, and returns lagged for years. This episode illustrates that even great businesses can become poor investments if bought at inflated prices. It serves as a reminder that valuation matters, regardless of a company's reputation or growth prospects. Let's examine Cisco Systems as a modern case study. Despite being a leader in networking technology and consistently profitable, Cisco's stock became a cautionary tale for investors. During the dot-com boom, many purchased shares at extremely high valuations, expecting rapid growth to continue indefinitely. However, even though the company remained fundamentally strong, its stock price stagnated for years, failing to deliver meaningful returns to those who bought at the peak. This phenomenon, often referred to as dead money, highlights how paying too much for even the best businesses can lead to disappointing investment outcomes. Cisco's experience serves as a reminder that valuation matters, regardless of a company's quality or market position. Many people mistakenly believe that a great business automatically makes for a great investment. This popular interpretation overlooks a crucial factor: the price you pay. Even the most successful companies can be poor investments if their shares are purchased at inflated valuations. Ignoring price means disregarding the potential for future returns to be diminished, regardless of the company's underlying performance. True investment success requires not just identifying strong businesses, but also ensuring that the purchase price allows for meaningful growth and value. By confusing business quality with investment quality, investors risk overpaying and undermining their financial goals. Warren Buffett's famous quote is often cited by investors looking for guidance, but its true meaning is frequently misunderstood. The context behind his words reveals a deeper philosophy about patience and discipline, rather than a simple formula for buying stocks. Buffett's intention was not to suggest that investors should rush to purchase shares whenever prices fall. Instead, he encourages careful consideration and long-term thinking. By understanding the hidden context, it becomes clear that this quote is not a direct buying strategy, but rather a reminder to remain rational and avoid impulsive decisions in the market. Warren Buffett's investment process is both disciplined and methodical. He begins by searching for businesses with strong fundamentals, focusing on companies he understands and trusts. Once a potential investment is identified, Buffett carefully assesses its intrinsic value, analyzing financial statements and long-term prospects. He waits patiently for the market to offer a price that provides a significant margin of safety, ensuring that he pays less than the company's true worth. Only when these criteria are met does he make a purchase. After buying, Buffett's approach is to hold on to his investments for the long term, allowing compounding growth to work in his favor. This strategy reflects his belief in the power of patience and thorough analysis. The American Express salad oil scandal of the 1960s stands as a classic example of Warren Buffett's disciplined investment approach and his keen focus on price. When American Express shares plummeted due to a massive fraud involving falsified salad oil inventories, many investors panicked and sold their holdings. Buffett, however, recognized that the company's core business remained strong and its brand was still trusted by consumers. Seeing the stock as undervalued, he invested heavily, confident that the market had overreacted. This decision ultimately paid off as American Express recovered and its share price soared. Buffett's actions in this case highlight the importance of separating short-term market noise from long-term value and demonstrate how disciplined analysis and attention to price can lead to exceptional investment outcomes. The quote emphasizes the importance of investing in high-quality companies while also ensuring that the purchase price is reasonable. It suggests that true success in investing comes not just from selecting strong businesses, but from exercising patience as the market eventually acknowledges their value. This approach requires discipline to avoid overpaying and the foresight to recognize long-term potential. Ultimately, it highlights that value is often realized over time, rewarding those who are willing to wait for the right moment. The message encourages investors to combine careful selection with steadfast patience for optimal results. As we examine the evidence, a pattern begins to emerge, one that often goes unnoticed by even the most seasoned investors. Hidden within familiar financial advice and commonly repeated quotes lies a silent killer, quietly shaping decisions and outcomes. This subtle influence can trap investors, leading them down a path of missed opportunities and unexpected losses. By carefully dissecting the language and assumptions embedded in these quotes, we can uncover the underlying risk that so often remains concealed. The next step is to reveal the true nature of this silent killer, shining a light on the dangers that lurk beneath the surface of conventional wisdom. The word eventually often carries a subtle promise of future reward, encouraging investors to hold on to hope even when they've paid too much. This mindset can become a psychological trap, convincing individuals that patience alone will turn a poor investment into a profitable one. Instead of reassessing their decisions, investors may cling to the belief that time will solve everything. However, markets don't always recover in ways that justify overpayment, and waiting indefinitely can lead to missed opportunities elsewhere. Recognizing the power of eventually is crucial for breaking free from this mental prison and making more rational, informed choices. Warren Buffett is renowned for his disciplined patience, consistently waiting for opportunities where the price aligns with intrinsic value. Unlike Buffett, many investors fall into the trap of ignoring price, instead relying on hope that their investments will eventually succeed. This approach often leads to indecision and paralysis as emotions override rational analysis. While Buffett's method is grounded in careful evaluation and restraint, those who depend on hope may find themselves unable to act when market conditions change. The contrast highlights the importance of maintaining a clear strategy and resisting the urge to make decisions based solely on optimism. Ultimately, Buffett's success demonstrates that patience, coupled with a focus on price, can be far more effective than wishful thinking. When a quote omits the price, it leaves investors in a state of uncertainty. Without knowing the current value, patience becomes more than just a virtue. It transforms into a risky waiting game. Investors may hold on to assets, hoping for favorable changes, but the lack of price information can lead to missed opportunities or unexpected losses. This absence makes it difficult to gauge whether it's the right moment to buy, sell, or simply hold. As a result, waiting for clarity can become expensive, both in terms of potential returns and the psychological toll of indecision. Ultimately, the missing price variable forces investors to navigate the market with incomplete information, increasing the stakes of every decision. Many investors believe that simply owning shares of well-known companies guarantees safety and long-term success. However, true investing peace of mind comes from purchasing assets at a price below their intrinsic value. This approach, known as buying value at a discount, helps protect against market downturns and unexpected challenges. By focusing on the relationship between price and underlying worth, investors can reduce risk and improve their chances of achieving solid returns. Ultimately, it's not just the quality of the brand that matters, but the price you pay relative to its actual value. The word eventually often carries a sense of waiting or delay, but for disciplined investors, it represents something far more rewarding. It becomes a victory lap, a celebration of patience and sound decision-making. Those who invest wisely understand that time is on their side, allowing their investments to grow and compound. In contrast, for those who overpay or chase quick gains, eventually can feel like a prison sentence, marked by regret and missed opportunities. By reframing eventually as a testament to perseverance, investors can appreciate the long-term benefits of discipline and strategy. Ultimately, it's a reminder that true success in investing comes to those who are willing to wait and trust the process. If you found these insights valuable, consider joining our community by liking and subscribing. Your engagement helps us continue exploring the world of investing together. We invite you to share your thoughts on overpriced, great companies. Do you think their valuations are justified, or is caution warranted? Let us know in the comments below. Additionally, if there are investing quotes or topics you'd like us to analyze in future episodes, feel free to suggest them. Your participation shapes the direction of our discussions and ensures we cover what matters most to you.